In our previous session, we had kind of outlined broadly what is going to be the drivers for the P&L for Maruti Suzuki. And we had done on our assumption sheet a detailed level discussion on what is the growth in the units of cars that they're selling, both in domestic markets and export markets. What's the capacity utilization they have? What is the market share that they hold? What is the change in realization per vehicle and why is that changing? What is excise duty as a percentage of sales, and major costs, raw material cost, employee benefit expenses, and other expenses per car sold, and so on and so forth, including tax rates, right? We had then gone ahead and put in the capex schedule and put in the data around what is likely to be gross long-term assets per car capacity. And we have, if you note, added the data for FY13 as well and calculated, and we see that if you have to build up a capacity of one more car, it takes about 1.5 lakhs. This is INR, so it takes about 1.5 lakhs to put that capacity in, right? Now we're going to build in what is going to be the capex and hence what is going to be the depreciation and so on and so forth in the entire equation, right? What we're going to do is before we begin, actually, let me also run you through the fact that we've added two sheets here. One is for the calculation of beta of Maruti, and the other is the cash flow sheet where we will build in the final DCF valuation that we are going to do. Right? Let's start projecting the drivers for the balance sheet data first as we go ahead. Right? So let's quickly go to the capex schedule and insert a row above this, and I'll put in the actual depreciation expense, and I'll link this to the P&L where the depreciation expense is given. So we have the depreciation data available on the same sheet should we want to reference it anywhere, right? Now we say that this depreciation is actually, if you look at the last few years net fixed assets, what is the data around depreciation for net fixed assets of the previous year? That's what we are getting in terms of our depreciation numbers, right? So that's broadly the contour of what we are up to. We could simplify the formula a little bit by taking this divided by this. That's what we were doing earlier, and just extend it ahead and we get the same data, obviously, right? So we are dividing depreciation by the net long-term assets of the previous year. We see almost 18% is the write-off that happens every year. Shouldn't matter too much as we go along, right? Now let's try and build what is going to be depreciation for, let's say, the next year as we go along. So this would become an assumption. From here on, whatever is going to be an assumption in our data points, we're going to build that into our model in a shaded cell, right? So let's say this is an assumption and we put it here. So we can assume that this is going to be the same as last year. What that would ensure is 18% into the last year number gives me the depreciation for this particular year, right? Also, we say that there is a capex on account of wear and tear. Whatever wear and tear happens last year, I'm going to project that as a number this year in terms of the capex. And total capital expenditure is going to be 2470 plus whatever capex happens on account of capacity expansion. We'll read up about the capacity expansion plans of the company as we go along, right? So that's broadly the contour of what is the total capex. If that is the total capex, the gross fixed asset should change accordingly, right? So what is going to happen is I'm going to combine the tangible and intangible gross fixed assets, and to this we are going to add whatever is the total capex in the year. Similarly, I'm going to combine the accumulated depreciation and amortization of last year, and to this we are going to add what is going to be the depreciation expense of the year. And the difference of these two, assuming capital work in progress remains where it is, the difference of these data points, A minus B plus C, is going to give me the total long-term assets. Remember, this is just the formula linkage at this point of time. Two data points that we need to discuss. One is what we did with capital work in progress. What is capital work in progress? This assumes that there is some facility that is under construction at this point of time. Now, whether you keep it here or you add it here and make this 0, it really doesn't matter, because on the context of depreciation, you're anyway taking this entire thing into account. And anywhere else, you're not really using anything out of this data. So you can either make an assumption saying that whatever was being under construction last year, a similar amount will always be under construction next year onwards as well. Or you could just put it down to 0 and take 1882 here, add it there. That's a non-cash transaction, is not going to impact your valuation any which way, right? So that's effectively what we have done. We have left it there. The second thing is we have just linked the data points in a fashion that gross long-term assets, tangible, intangible become together. If you want, we can kind of merge these cells. If you want, we can merge these cells as well, so that we know that these two values have been combined here, right? So that's the gross long-term assets, intangible and tangible, that we have looked at, right? And this, I think we have incorrectly put in the data. This should be tangible and this should be intangible, right? That's what the data is. Now, uh, that's the depreciation data. Let's quickly go to the debt schedule and try and see what kind of debt the company is going to raise. Now, first things first, this is going to be a projection, and net debt changes most likely are going to be projections, right? Now, cost of debt for a company like Maruti in India would be about close to 10 to 11%. I don't think it would move significantly from there. And whatever is the total debt here is the sum of short-term and long-term debt. The finance cost should be 10% multiplied by the total debt. At this point of time, nothing appears. Now, net debt changes. I would want this to be net long-term debt changes is what we are looking at, right? Let's assume the company does not borrow anything. They borrow 0, right? If they borrow 0, last year's long-term debt is going to be the same as this year's long-term debt, and you will immediately see that there is an expense that would come out in the form of interest cost of 15 crore, right? So we've also kind of put in the interest cost component here. We will build on this as we go along, because short-term debt is not available at this point of time. We'll do work on that as well, right? Now, let's go back to our assumption sheet. And before we move ahead, we do need to talk a little bit about what are the working capital assumptions of the company, right?